I'm Brian Hartstein, the Director of Corporate Development here at Baintree Wealth Advisors, and I also head up the 401k team here at Baintree Wealth Advisors. And we are excited that we are now the advisory firm for your 401k plan through Affiliated Dermatology. So we wanted to take a few minutes today to go over the different parties that are involved in working on your 401k plan with Affiliated Dermatology, as well as talking about the plan provisions that are specific to your 401k plan, and also go over the investment platform for the account that you may set up if you are participating in the 401k. So just to jump right in and let you know who your team is here at Baintree Wealth Advisors. Again, myself, Brian Hartstein, and today with me on this webinar, I also have Chris Roger and Jonathan Jangle, who are the financial advisors who are dedicated to working with you and the 401k plan for Affiliated Dermatology. We also have Rena Blanco and Jessamaya, who help in a variety of different functions. And if you contact us up here at our office, you most likely talk to one of them first, and then they will get you to the right people that can help you answer your questions and give you any support that you may need. But when we look at the 401k plan for Affiliated Dermatology, there's really three groups that are involved in helping make sure it's operating properly and maintaining it throughout the year. The first is us, Baintree Wealth Advisors. We provide support to the trustees and the people who help run and operate Affiliated Dermatology, as well as the HR department, and work with you as a participant and employee of Affiliated Dermatology in any capacity related to financial planning. So for those of you that might need help with things such as determining your personal level of risk tolerance, optimizing the investments in your account, answering general questions about the plan, or answering any financial planning questions in general, that's what we're here for. And there's no cost for you as an employee to access us and our services. So we really hope that you reach out to us so we can find out how we can best help you maximize your 401k account for retirement. Also involved in operating the plan is pension strategies. Pension Strategies is what is called a third-party administrative firm, and their role is simply to make sure that the plan is compliant throughout the year and to file the proper tax forms for the plan on an annual basis. And finally, there's MassMutual. MassMutual is the investment platform that has been built so that you can actually open your individual account and invest your monies that you contribute to your 401k plan accordingly. So let's do a quick overview of the plan highlights, or what we call plan provisions that are specific to your plan through Affiliated Dermatology. So if we start in the upper left, eligibility requirements. So who is eligible to be in the plan? So if you're of age 21 and you've been with Affiliated Dermatology for 6 months, you are eligible to be in the plan, and then you can enter the plan at the first day of the following month after you satisfied your 6 months of eligibility. So for example, if I was hired today, which is June 25th, I'd be eligible 6 months from now and could enter the plan the first day of the next month. If for some reason I did not enter the plan on the first day of that next month, I can enter the plan anytime after that since I've already satisfied eligibility. Now, to set up your account on the system, you do need to contact HR once you're eligible so they can set you up so you are able to create your own individual account on the MassMutual platform. If you have any questions in regards to that, please contact HR or contact us so we can certainly help. Contributions. This has to do with what we call salary deferral, which is a percentage amount or hard dollar amount that you choose on a per pay period basis to defer from your own pay into your 401k account. And you have two types of contributions that you can make. One is what we call traditional 401k or pre-tax, and the other is a Roth contribution. The difference between those two specifically has to do with tax or taxation. And John and Chris are going to walk through that, the specifics of those and the details of those a little bit later in this webinar. We do get a lot of questions in regard to that about what is right for a specific person, and we can certainly help you determine that if you contact us. Employer contributions. So affiliated dermatology has a very rich match in place, meaning they are going to contribute 100 cents of every dollar up to the first 3% of your compensation for anyone who's eligible to be in the plan. So if you're an employee and you make $30,000 a year, you will have the first 3% of your compensation, or $900, put into your account for you by affiliated dermatology. They value you as an employee. It's a wonderful benefit. It's what we call free money. So again, it's a great plan, and that's one of the reasons we love help supporting plans like these. For contribution limits for 2020, if you're under age 50, the maximum amount that you can contribute from your own pay is $19,500. And if you're over age 50, you have a catch-up provision, meaning you can put an extra $6,500 away for this year. So again, under age 50, your max is $19,500. And if you're over age 50, your maximum for 2020 is $26,000. That does not include your employer match. That's simply the maximum that you can put in from your own salary. And the last box here is vesting. This can be a somewhat confusing area. So again, if you have any questions in regards to this, please feel free to reach out to us. But obviously, any monies that you put into your account from your own pay are 100% vested at all times. And the employer match, which is that 100 cents of every dollar up to the first 3% of your compensation, is also 100% vested at all times. Meaning, if you ever left the company, that's always going to be your money. You can take it with you. And we'll talk a little bit about how you might access the monies in your account on the next slide. But again, 100% vested at all times. There is a part of this 401k plan that is what's called a profit sharing plan contribution, meaning that affiliated dermatology might choose to put an additional amount into the plan on behalf of everyone. And if you're an eligible employee, you'll be entitled to a portion of that. They don't have to do that every year, but I know they've done that in the past and they may do that going forward. For that specific part of the contribution, which has to do with what's called profit sharing, that is on what's called a 6-year graded schedule, meaning at the end of 2 years, starting from your date of hire, not date of entry, but date of hire, you'll be 20% vested. At the end of 3 years, you're 40% vested. At the end of 4 years, you're 60%, 5 years, 80%. And at the end of 6 years, you'll be 100% vested. That is what we call golden handcuffs, meaning it's a benefit that affiliated dermatology wants you to enjoy as a valued employee, but they're hoping that you'll be around and working for affiliated dermatology for quite some time. So again, many plans do not have that. It's a very, very valuable benefit, but again, it is a little bit different than what we call the 401k deferral and the 401k employer match. But again, any questions, obviously, please feel free to call our office. We can certainly help answer those for you. Loans. So refer to what's called your summary plan description for loans, but in general, you can borrow up to 50% of your vested account balance. I believe the minimum is $1,000 and the maximum will be $50,000. As a general rule, when we look at financial planning here, we usually advocate that people not use their 401k account to borrow against, as we help, you have other resources built up that you can tap into. And we just don't believe it's a great place to borrow from. However, it is available to you if you do need it, and we do understand that sometimes people do need to utilize that provision of the plan. Hardship withdrawals, there are some specific rules that you have to satisfy in order to take what's called a hardship withdrawal. The IRS has defined those rules. If you do need or you think you qualify for one, just contact HR or contact us or Pension Strategies, and we can walk you through that. Distributions, which is how do I access the monies in my 401k account? I've been contributing for some time. I just don't know how or when I would actually get to utilize that money. So there's several different ways that you can access your monies via distributions. And 2 are going to be the most common. The first is what we call separation from service. If you ever leave affiliated dermatology, you can take the balance of your account with you. You can roll it over to an IRA rollover account. You can roll it to your new employer's 401k account. In either of those scenarios, you will not be taxed. Or you could simply take the monies and cash it in and utilize the monies on a personal level. However, you will be taxed in the year that you take those monies out, as well as if you're under age 59 and a half, there is a 10% premature distribution penalty on the gross amount. So obviously we advocate somebody not do that unless they absolutely have to. You really want to protect your money from taxes as long as possible. Disability, if you satisfy Social Security's definition of disability, you can access the monies without penalty, without that 10% penalty. And if you retire at age 65, you can access those monies without penalty as well. And unfortunately, if you pass away while working, you won't receive the benefits, but somebody will. And that somebody will be the beneficiaries that you designate on your account. We get a lot of questions about beneficiary designations here. So if you do have questions, please feel free to call us. We can help you there. Arizona is a community property state. So if you are married, you must name your spouse as the primary beneficiary of your account, unless he or she signs off and says that's okay, that you do leave that to somebody else. Beneficiaries can be changed at any time. So we always urge participants to every maybe year or two check your beneficiary designation to make sure you are leaving the monies to whom either you should be or who you want to be. We've seen many cases where people don't ever check those, and 10 years later, the beneficiary of an account is not who they really intended it to be. And unfortunately, there's nothing you can do about it once someone passes away. So again, any questions there, that's what we're here to do to help. So that was just a quick overview of what we call the specific plan provisions. But again, I covered a lot of ground. If anybody has any questions in regards to these or are confused, please feel free to let us know. At this point, I'm going to turn it over. And we're going to talk about maybe more some of the fun things that you can do in your account, the benefits of participating, the investment platform, and what you can do with your monies.
Thank you, Brian. This is Jonathan Jingle, one of the financial advisors over here at Banyan Tree Wealth Advisors, going to get into some of the benefits of participating in your 401k plan. So some of these items Brian may have touched on briefly. We'll go into a little bit more detail. So you do have two different ways in which you can save from a tax standpoint. You have tax-deferred savings, and you also have after-tax savings through Roth contributions. There is a distinction that needs to be made between the two, and it's going to depend on your personal situation and tax situation on which one is better for you in a given time period. So if you make just a traditional savings, tax-deferred earnings to that component of the plan, you do not count that contribution as income in the year that you make the contribution. So the way that you can kind of conceptualize this is money is taxed either on the way in or on the way out. So for instance, with a traditional contribution, you're not paying taxes in that year, but when you go to take the funds out, you will be paying taxes at whatever those rates are at that point in time. However, with that Roth contribution, you don't get to basically not show that contribution on your taxes for that given year. So you are still claiming that as normal income and it's going into the 401k account. However, any contributions that you made and the earnings over time in that Roth portion will not be taxed on the way out when you go to utilize the funds. So really you have to look at your specific tax situation in a given time period. In general, maybe using the Roth component is better for an individual that is younger and maybe at the lowest earning point in their life, where a deduction is not going to go as far, or the tax deferral will not go as far on the traditional component. So again, just depends on your situation. We'd be happy to talk through what makes the most sense for again, your given situation. Also, another benefit of participating in the plan is having that long-term goal, having compound earnings, using the time that you have working to really grow this nest egg to utilize as future income. And one of the ways that we do that is through something called dollar cost averaging. So this is not the type of account that you're going to be day trading in. It is longer term. You're going to be more of that buy and hold strategy, which means as you make contributions, you're going to be purchasing the same assets, those same market-based assets at different price points as those assets fluctuate. And the benefit of that is you are getting an average on that cost. You're not necessarily overall buying at a high point or buying at a discount, and it averages the cost and can smooth out the volatility of your account over time. Additionally, really big component is having this be automatic, where you don't have to make the decision on how much you're going to save necessarily in a given month. Once you kind of evaluate your situation, figure out how much it makes sense to defer, that's kind of out of sight, out of mind, and earmarked for long-term growth and savings, again, to utilize at your retirement.
One thing we do like to point out, because we do get some questions in regards to this, is can I change my deferral percentage amount once I've set that up? And the answer is you could absolutely change it if you wanted to increase it or decrease it. You can certainly move that percentage or hard dollar amount. You simply need to let HR know, and then that will take effect at the beginning of the next quarter. So you could change it any time during a quarter, but the change will actually not be effective until the beginning of the next quarter.
Great. And now what we look at too as part of participating in the plan is where will your retirement income come from? So the 401k is not meant to be the sole account that you're going to draw income and maintain your lifestyle after you've stopped working. So you have to figure out how it fits into your overall plan. It might take up a component of that overall retirement income, but identifying other personal savings, other retirement accounts, other benefits like pension and Social Security. What are those values going to be at your target retirement date? And then how does the 401k dovetail into those other resources to make sure that you have secure income throughout your retirement? So again, that's an area where we can help identify what are the different areas that income is going to come from. What is our target for the 401k? So how much should you save in general, again, within the 401k? Well, like Brian had mentioned, that you have the option to decide how much you want to defer from your paycheck. So first and foremost is identifying what have you saved already, what other resources are you going to have, and what is maybe the deficit that I have in terms of future retirement income. And once you identify that, then you can kind of figure out, okay, if I'm making X amount of dollars now, I should put away this percentage. And as I make more money, either keep that percentage the same or even increase it if there's a specific target in terms of accumulation value of your account that we need to hit. Just to kind of reiterate what Brian went through before in the beginning, maximum savings currently for 2020, if you are under age 50, it's going to be that $19,500. You have that additional $6,500 if you are over age 50, which brings you up to $26,000. A lot of people generally recommend at minimum to save 10% of your income now to make sure, assuming your expenses after considering inflation and things of that nature, considering where your expenses are now, 10 to 15% of your income would be a good target. Again, not to solely rely on the 401k, but have it be a vital component of that overall retirement income. So we always encourage start with as much as you can, doing a budget, an overall budget for your household, and then figuring out what is that dollar amount, what is that percentage of income that I can afford to save right now, and then increase over time, assuming that you likely, if you're a younger worker, will be making more money in the future. And here is kind of really a powerful slide, I think, and it shows the power of compound earnings. And the most important variable there is having time. So it's not necessarily how much you make on your money, how much you put away, and this really illustrates it very well. You have two individuals that are effectively saving the same amount and effectively earning the same return on their investment over time. However, that first individual started 10 years earlier, and you can see the power just with that 10-year period of time in terms of how much more he will have to retire with at age 65. So we really encourage get started early. That is going to be the most powerful variable in your favor for having an account balance that works with your overall plan to then utilize as income in the future. And just again, to reiterate, Roth versus traditional. So here's kind of a good breakdown. Contributions from Roth are after tax, so you're not getting to not show that on your taxes in the year that you make it in terms of income. So again, the pre-tax might be a better component for a higher earner that is looking to limit their tax liability in a given year and thinking that their income will be lower when they retire. A lot of times we encourage younger workers to look at the Roth because that after-tax contribution is not going to be as big of a liability when they make it. And then again, the big component too comes when that money comes out. Roth is going to be completely tax-free, whereas traditional or the pre-tax component will be taxed as normal income when you take it out. One thing also I just wanted to mention as well is if you decide to contribute to the Roth, the employer contribution is naturally going to go into that traditional pre-tax. So you'll have two components, Roth and traditional, even if you do contribute to the Roth.
Okay, thanks, John. Hi, everybody. My name's Chris Roger, one of the financial advisors here with Tree Wealth Advisors. And we talked about, well, how much can you add into the 401k? Should you do pre-tax? Should you do Roth? And if you're unsure, that's what we're here for. You can feel free to reach out to us and ask questions on that. And now you decided how much to put into the 401k plan. Now the question is, well, when the money's in there, what do I do with it? So, with the 401k plan, you'll have a handful of choices that you can choose from, generally from more conservative type of investments to more aggressive. So you have your cash and cash equivalents. That's going to be cash, just like cash at the bank, except it's in your 401k plan. It's not really going to swing day to day in the market. It's going to be safe. It's going to be stable. If you're a very conservative investor, that might be the right thing for you. Bonds are generally going to be used more for income or preservation inside of a portfolio. Generally speaking, bonds inside these 401k plans, they're going to be a little bit more safe and stable, a little bit more risk than the stable value, but they'll have the ability to make more. And then we have stocks or equities, and this is, depending on what type of funds that you get involved with, will determine the type of risks that come with it. But generally, these are the three types of asset classes involved with the 401k plan: stocks, bonds, and stable value or cash and cash equivalents. So, the biggest thing to really determine here in order to decide where to invest your money inside your 401k plan, it's not necessarily to try to just pick the funds that had the best returns, because the returns change every year. So we look at 2019 was a great year in the stock market. Here we are in June and in 2020, and we've had a roller coaster year. So just because something did very well last year doesn't mean that it will do the same or even better the year following. So you want to not necessarily try to chase the return. You want to try to understand the risk that comes with the type of investment that you pick. So generally, these small cap, these red, orange type of color code type of funds here, they're going to have some higher risk compared to the lower returns, stable value type of investments like we talked about. So some of you, maybe you're 20 years from retirement. You might want to have higher risk because you have a long time to make up. Even if the markets have some down years, you have the ability to come back. Well, if you're 20 or 30 years from retirement, that's okay to maybe take a lot of risk for some of you. But for those of you that are maybe 20 days from retirement, you might not want that much risk. So trying to find this balance of risk versus reward is very important. And one of the ways that you can do that, you can jump online and take a risk questionnaire, and that'll help you really determine what your comfort zone is with risk. So with our platform as well, with Tree, you can go on our website. We have a great platform called Riskalyze. And what it does is it tries to quantify your investments to give you a risk number. So when it comes to risk on the platform here, you have the ability to do a couple different things. Number one, if you're maybe investing isn't your wheelhouse and you don't like to go and pick your own different types of stocks and bonds, you can enroll in what's called a target date portfolio. And the target date portfolio is going to look at your date of birth and your estimated age of retirement, which is going to be generally age 65, age 67. And as you get closer to that age, the target date portfolio is slowly going to become more conservative, selling out of stocks and gradually having more bonds and accumulating more bonds over time. So what if you say, well, I don't really want my account to get more conservative over time? Well, then you might want to take the other approach here, which is a build your own portfolio approach. And that ties into the risk level here. You get to choose from these different asset classes, but you want to come up with a diversified type of plan with maybe both some stocks, some bonds, or if you're more conservative, maybe bonds and maybe some stable value investments. But these are the kind of things that our team can help you with if you're not exactly sure which funds to pick or how to determine what amount of risk I should be taking. So here's just an example. You can see this. The blue space here represents the equity positions inside of a target date fund. So you can see someone here 40 years away from retirement, they have about 90% allocated to stock inside of their target date fund. And you can see someone 5 years into retirement, really maybe they only have 30% of their target date fund invested in stocks. And as you get older and more progress more through retirement, the fund is slowly going to become more conservative. Again, that is something that you have the option to do. You don't have to invest in that. You can build your own type of portfolio, and if you need help with that, that's what our job is, and that's what we can help you with. So on the platform here, you have the ability to go in online and change your contribution date. Like we talked about, you want to try to save as much as you can, generally 5 to 10%. If you can do more, go ahead. We would certainly encourage that. And you don't necessarily want to go in and change your account contributions or your investments on a daily basis, but at the same time, you don't want to never look at it either. So we normally recommend you want to review your account at least 2 to 3 times a year. You can access your statements, or you can go right online to the Mass Mutual platform. And then the other thing that we always encourage participants to do as life progresses and as life changes, whether it be marriage, divorce, children, grandchildren, whatever the case may be, you want to make sure you're updating your beneficiaries, because if you don't update your beneficiaries and something happens to you, whoever is listed there is going to be the one that receives the funds. Whether that's maybe the person you didn't want, doesn't matter. So you need to go and update that, especially if you're going through any sort of life transitions. So, one of the things like I talked about on our platform, you can go to our website, baintree.com, and you can click on our Riskalyze software. And what this does is it tries to help you gauge out what your comfort zone is really for risk.
Yeah, and I know in a few slides before this, we were talking about assessing your personal level of risk, and we had a web address in there. Don't use the jhtools.com. Go straight to baintree.com and access Riskalyze via our website. It's the easiest thing to do. Just wanted to make sure that everybody knew that.
Yep. So just ignore the John Hancock risk platform, but jump online to our baintree.com. Go through the risk questionnaire. It's very simple, and when you complete the questionnaire, and you can see here in the bottom right corner, it's going to give you a risk number. Generally, the closer you are to 100, the higher the risk you're comfortable with. The closer to 1, the more conservative you are. So what our job is to help you understand is, what does that number actually mean, and how can you make your investments match that number? So feel free to reach out to us. There's no cost to reach out to us and ask questions. Our job is to help you and make life easier for you.
Thanks, Chris. Thanks, John. Great job. And, if you take away anything from this webinar, hopefully the number one thing is we are here to help assist you, just like Chris and John said. So hopefully, a lot of this made sense and helped kind of bring everything together in terms of how the 401k operates, who works on it, what are the benefits to you, and what specific requirements there are for the plan in terms of affiliated dermatology and a lot of the value that they want to bring to you as an employee. So feel free to call us, email us, any other way you can access us. We are here to help, and we're excited to start working with you. So we hopefully